Mortgage terms: 1,000 families of color, created by one of our interns. 5-1 adjustable rate mortgage. 5-1 adjustable rate mortgage ARM is a type of loan where the interest rate remains fixed for the first 5 years. After initial period, the rate adjusts annually as indicated by the 1. The most common fixed periods are 3, 5, 7, and 10 years, with 1 year adjustment period for being most typical. If you're considering an ARM, it is essential to thoroughly review the contract and ask questions to ensure you understand the terms. Ability to repay rule. The ability to repay rule requires most mortgage lenders to make a reasonable and good faith assessment that you will have the capacity to repay the loan. Adjustable rate mortgage ARM. An adjustable rate mortgage ARM is a loan where the interest rate can fluctuate, typically based on the index interest rate. Your monthly payment may increase or decrease depending on the loan introductory period, rate caps, and the movement of the index interest rate. While an ARM often starts with a lower interest rate and monthly payment compared to a fixed rate mortgage, both the interest rate and payment can rise significantly over time. Amortization. Amortization involves the regular payments on a loan so that the full amount decreases over time. While most home loans amortize fully, some do not, meaning you still may owe money after completing your payments. Certain loans may only cover the interest or less than the interest due each month, leading to negative amortization, where the balance grows instead of shrinking. Other non-fully amortized loans may require a large balloon payment at the end of the term. Make sure to understand specifics of your loan. Amount financed. It means the amount of money you're borrowing from the lender minus the most of the upfront fees the lender is charging you. Annual income is a factor in a mortgage loan application and generally refers to your local earned pre-tax income over a year. Annual income may include income from full-time, part-time work, self-employment, tips, commissions, overtime, bonuses, or other sources. A lender will use information about your annual income and your existing monthly debts to determine if you have the ability to repay the loan. Whether a lender will rely upon a specific income source or amount when considered for your loan will often depend on whether you can reasonably expect the income to continue. Annual percentage rate, APR. An annual percentage rate, APR, is a broader measure of cost of borrowing money than the interest rate. The APR reflects the interest rate, any points, mortgage broker fees, and other charges that you may pay to get the loan. For that reason, your APR is usually higher than your interest rate. Appraisal fee. An appraisal fee is the cost of a home appraisal of a house you plan to buy or already own. Home appraisals provide an independent assessment of value of property. In most cases, the selection of the appraisal and any associated costs is up to your lender. Automatic payment. Payments allow you to set up recurring mortgage payments. Through your bank, automatic payments can be convenient to make sure that your payments on time. Balloon loan. For mortgages, a balloon loan means the loan has a larger than usual one-time payment, typically at the end of the loan term. This one-time payment is called a balloon payment and is higher than your other payments, sometimes much higher. If you cannot pay the balloon amount, you might have to refinance, sell your home, or face foreclosure. Bi-weekly payment. In a bi-weekly payment plan, you make half of your month mortgage payment every 2 weeks, resulting in 26 payments per year, equivalent to 1 extra month payment annually. This helps you pay off your loan faster by reducing the typical principal. Before opting for a bi-weekly plan, review for your loan terms for any prepayment penalties and check if your service charges for this plan. Alternatively, you may achieve similar results by making one extra monthly payment each year without incurring additional. Closing disclosure. A closing disclosure is a mandatory 5-page form that outlines the final details of your chosen mortgage loan. It includes information on the loan terms, your estimated monthly payments, and the total fees and costs associated with obtaining your mortgage. Construction loan. A construction loan is usually a short-term loan that provides funds to cover the cost of building or rehabilitating a home. A conventional loan. A conventional loan is a mortgage loan that is not insured or guaranteed by the government, such as under the Federal Housing Administration, Department of Veteran Affairs, or Department of Agriculture loan program. A cosigner or co-borrower. A cosigner or co-borrower is someone who agrees to share full responsibilities for repaying mortgage loan with you. This individual is obligated to cover any missed payments or can be liable for the entire loan amount if you fail to pay. In some mortgage programs, a cosigner does not hold any ownership interest in the property and is not listed on the title. Having a cosigner or co-borrower provides the lender with added assurance that the loan will be repaid, but it also puts the cosigner or co-borrower's credit and finances at risk if you default on the loan. Credit history is a record on your credit accounts and your history of paying on time as shown in your credit report. Consumer reporting companies, also known as credit reporting companies, collect and update information in your credit record and provide it to other businesses, which you use to make a decision about you. Credit reports have information about your credit activity and your current credit situation, such as your loan, paying history, and status of your credit accounts. Credit report. A credit report is a statement that has information about your credit activity and current credit situation, such as loan, paying history, and status of your credit accounts. Lenders use your credit scores and the information on your credit report to determine whether you qualify for a loan and what interest rate to offer you. Credit score. A credit score predicts how likely you are to pay back on a loan on time. Companies use a mathematical formula called the scoring model to create your credit score from the information in your credit report. There are different scoring models, so you don't have to have just one credit score. Your score depends on your credit history, the type of loan product, and even the day when it was calculated.